March was a very volatile month, which saw significant deleveraging across the board from hedge funds and from CTAs and long-only investors, driven mainly by the events in Ukraine following the Russian invasion. The markets bottomed in mid-March, roughly 3 weeks after the invasion started, and this is the sort of time frame that it takes for the markets to react, people to reposition their portfolios, deleveraging to occur, and the news cycle to be fully absorbed. So 3 weeks into the invasion, we saw the markets bottoming. We saw a relief rally since then through March with some chasing of markets from people, and this led to quite a big squeeze into the end of the month, where the markets broadly ended up flat to slightly up or slightly below where it started the month of March. Talking about the individual events driving markets last month, obviously the big one was the Russian invasion of Ukraine. And as that situation has developed, both sides have become more entrenched. There seem to be less and less good options in terms of a resolution. And now with the talk of war crimes, it seems more difficult to see how we can return to any sort of business as usual between the West, should we call it, and Russia going forward while Putin remains in power. We felt coming into the whole Russia situation, we've been reducing our exposure to Russia in the portfolio. We had about 45 basis points of exposure to 2 different Russian names, which led to some hit on performance, but overall we ended up the month positive despite our Russian holdings. The other major thing going on in March was China's domestic slowdown, and eventually mid-March the Chinese policymakers hit the panic button and started to ease more aggressively. They also started to relax the burdens that they'd put on the financial on the tech sector, and this led to a very sharp reversal in the tech-dominated indices. For example, the HSCEI in Hong Kong had a one-day down 10% move, and then the following day an up 10%. We continued to come back now to the issues that had been dominating the market since the third quarter of last year, namely the fear of inflation, the worry about stagflation, the tightening Fed, and now talk about balance sheet reduction. All of these currents are significant headwinds for markets and will continue to cause problems around inflation being into the commodity space versus growth being impacted by higher discount rates as the Fed starts to tighten policy. Our strategy in this period has been to stay nimble, focus on our core ideas, and we continue to do so, and be ready to add to positions during dislocations, such as the ones in March, where we covered a significant number of our short ideas as those stocks hit our price targets, and we added to new long ideas in the portfolio. We also implemented some index level hedging for the first time in quite a while, as the correlations in markets have gone up, and introduced some options into that hedging profile where we've overwritten some of our core holdings, as well as buying downside protection in some of these markets. We continue to be nimble in the portfolio, adjusting our exposure as the markets change, and hopefully we'll be able to navigate these turbulent times going forward in the next few months. Thank you.